Hello and welcome to this session. This is Professor Farhat, in which we will discuss net present value, known as NPV. NPV is a financial tool, is a financial matrix used in what we call capital budgeting. Now, what is capital budgeting? We have a short session about capital budgeting in the prior session. Simply put, capital budgeting is when the company wants to invest in a big project, big ticket items, a new warehouse, a new building, new machinery. Well, they have to make a decision. They have to evaluate that decision from a financial perspective to evaluate whether the project, the asset that they're buying, the project, the consultancy, the advertising campaign, is it profitable or not? Should they undertake it or not undertake it? Now, the way we compute NPV will take the difference between the present value of cash inflows and the present value of cash outflows. So we're going to be repeating this formula a few times on this slide because it's very important to see this. It's the present value, I'm going to put it, of the positives of the inflow and the present value of the negatives. So what we do is we look at all the future inflows, all the future outflows, and compute their PV, present value. Now, if you don't know what a present value is, please go to my time value lectures because I assume you know what that is. Then we'll find the difference. In simple terms, NPV determines whether the project create or destroy value giving time. What do I mean by time? Given time means when you use the present value, you are factoring the inflow and outflow of cash in the future, taking into account time, because time is money, and taking into account the risk involved. Because when you estimate, when you are creating a project, you have to estimate future cash inflows. Look, the word is estimate, and when you estimate, risk is involved. So the net NPV will try to kind of help you quantify that risk. So this is the formula once again: NPV, the present value of future cash flows minus the present value of the investments and the cash outflow, which is the investment. Now simply put, how do we answer NPV? We hope that this answer is positive. If this answer is positive, it means we created value for the company. If the answer is negative, we would reject the project, because if we undertake this project, taking into account time and risk, cash flow and cash outflow, inflow and outflow, we don't want to undertake a project and at the end destroy value, having a negative net cash value. And this is what we will discuss in this session. The various components of net present value, the various components of NPV. What are the cash inflows? What are the cash outflows? How do we compute those using the time value? We'll go through a detailed computation, show you an example, advantages and disadvantages of this method. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Hello, my name is Farhat. You are here because you are either an accounting student, a finance student, or someone who's studying for their CMA or CPA exam. Great. You are looking for some additional help, and we can help you. I strongly encourage you to visit my website, farhatlectures.com. I offer additional lectures, resources, including PowerPoint slides, multiple choice questions, in some circumstances, exercises, and true-false questions. Our material is aligned with your CPA review courses, with your CMA review courses, with your college courses. I offer a risk-free trial that you can try to find out whether my website can help you or not. If you find it helpful, you subscribe, you keep your subscription. If not, you cancel and your risk is free. If you like this recording, if you like my lectures, you would like what's on the website, give me a chance to help you with your college courses as well as professional certification. I hope to see you on the website.
Starting with the key components of net present value analysis. The first thing I am going to discuss is the bad news. Not really the bad news, it's the negative cash flow, the negative cash outflows. First, always you start with outflow. Every time you make an investment, think about what you are doing right now. Right now, if you're listening to me, you're either a student or studying for some sort of a professional certification. You could be just investing in yourself. Now, if you're doing so, you're spending time, you're spending money, you're a subscriber. You are investing in yourself. When you go to school, you invest, you spend money. So initially, to start an investment, you have to pay out. That's the negative cash outflow. So I'm going to list for you the typical initial and ongoing expenses that goes with investments that you might see in your textbook, on your CPA, CMA exam, or other professional certification. The initial investment usually is the major cash outflow. So for example, the company wants to buy a piece of land, piece of equipment, set up a machinery. This will be usually the largest. Then as the project proceeds, they might have other expenses to maintain the machinery, to repair it. Why? Because this machine needs repairs, need replacement parts every once in a while. That's an expense. They also need to maintain it and repair. So those are all negative outflow of cash. Could be others, but those are typically what a company will have to take into account when they are investigating, when they are evaluating a capital project. Well, let's take a look at the good news. The good news is the cash inflows. What could be the typical cash inflows or the benefits from the project? The first one is the increase in revenue, sales or revenue, whatever you want to call it. Because once you undertake a new project, once you buy a new machinery, once you buy a new asset, what's the purpose? The purpose is to generate more revenue. So you will take that into account. Then, or sometime when you implement a new technology, for example, you used to use labor in your factory. Now you want to put a new machine. And once you put that new machine, you're going to eliminate all or part of the labor. What's that going to do? That's going to have cost savings. Cost savings are positive. They're looked at as revenues. Efficient improvement, reducing operating cost from advanced equipment. So on the problem, they might say cost saving is such and such per year. Well, that's the same thing as cash inflows because you invested in this company. Also, what could be a positive cash flow is reselling the asset later. Remember, on the previous slide, we purchased the asset. Now, at the end of its life, we might be able to sell it and sell it for some cash. Now, keep in mind, that's going to be in the future. What we have to do, we have to bring that cash to the present. Actually, we have to bring all the cash to the present. But this is a clear example that it's being sold at the end of the project. It means we have to discount it. Also, when we undertake this project, we might have to devote some fund for supplies, devote some fund for inventory, devote funds for additional expenditure. Well, those are called working capital. Those are negative cash flow when you invest in them, but when you recover them, they are positive cash flow. So on this slide, we can put working capital. When you invest in the working capital, it's a negative. Then at the end of the project, you might have some of these supplies, some of this inventory. You can resell it. It was tied up. Now you can reclaim it. It's positive. So that's another positive. So basically, those are typical ones. It doesn't mean those are the only ones, but those are typically what you would see in a textbook about a project. Now, in the real world, there are other expenses, other revenues, but again, we're talking textbook material here. Then we have the cash inflows, the cash outflows. What else do we need to compute NPV? We need the discount rate. The discount rate is what? Is the rate at which the future cash flows are discounted. And when I say future cash flows, those are the positives and the minus to their present value, reflecting the project risk and the company's minimum acceptable return. So how much is the discounted rate? So when we discount, what do we use? Which rate? The discount rate that the company wants to have. How do they determine this? Well, it could be their cost of capital, how much it costs them to borrow money or to raise money. The company might have a minimum acceptable return, and that's what they want to earn on this project. What's that minimum acceptable return? That's all what they want. Every time they want to undertake a project, they want to earn at least 15%. Can this project earn 15%? Now let's go through a step-by-step computation in computing NPV. Now this is the formula for NPV, and we're going to see what does that mean. It's the sum of all cash flows discounted divided by 1 plus r raised to the t. The sum of all of those. We're going to look at an example, but this is the short formula. First, identify the cash flows. List all the expected inflows and outflows, and I showed you what they are over the project. Then figure out the discounted cash flow. Adjust all future cash flows to their present value using the company discount rate, which often the cost of capital. So what we're saying is, look at the future, look at the minuses and the pluses, and discount all of those, inflow and outflow, to the present. That's what you do. Then step 3, subtract the initial investment. Usually at the beginning you're going to have a large minus. Subtract these investments from all the present value, and you will find your answer. Now I'm going to start with simple examples, then build it up to a more complex example. I'm going to start with a fixer upper house to show you a simple net present value without complicating things. So initial investments, let's assume you bought a house. It's a fixer upper. You bought this house. It's a broken house. It's in California. You purchase it for $250. You put an additional $250 immediately, and you invested in total $500,000 today. So you bought it, and a month later you fixed that house. You turn around a month later and you sold it for $600,000. Did you create value? Yes, you did create value. You created value of $100,000. How do I know this? The net present value computation. Your inflow is total $600,000. Your outflow is $500,000. You have a net present value of $100,000. Since this is a positive, you created value from this investment. Now, hold on a second. What is this simple computation, money in, money out? Yes, because remember what I told you. You bought it and you made the repair immediately, then you sold it immediately within a year. Therefore, the time value of money is not needed. So if you spend $250 today, it's worth $250, and if you spend another $250 today, it's worth $250. So you spend $500,000, and a month later you get $600,000. Well, there's no need to discount this information. Let's look at a little bit more involved example. Let's assume you started a startup organic fertilizer business. The startup cost was $28,000, and here's what's going to happen. When you start up this business, that's fine. You said it's negative $28,000 you have to invest today. And what happened for the next 10 years? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Every year you are going to receive from this business $5,000, $5,000, $5,000. Well, that looks like an annuity. And let's assume you want to earn, guess how much? 10% on your investment. Should you undertake this project? Here we have to use what's called the discounted cash flow, DSF, or the net present value computation. We're computing the net present value of this project. What we do is we find the present value of this annuity, and hopefully you know what I'm talking about here. Then we compare it to the 28,000. If it's greater, then we created value. So what we did is we took all the future inflow of cash, make it as of today, when we computed the present value, and compare it to how much we paid today, which is 28,000. Therefore, the present value of 5,000 over 10-year period using a discount rate of 10% equal to 30,722. Hold on a second. How did you come up with this number? Go to the present value annuity table, N equal to 10, because it's 10 period, an interest rate equal to 10, and you will find the factor. You will take this factor multiplied by 5,000. You will get the 30,722. Now, if you take 30,722 minus 28,000, you created a positive net present value of 2,722. The project has a small positive value. Nevertheless, it's a good investment because it's a positive net present value. Let's take a look at the third example where we have more computation involved. Now we understand the big picture. Let's look a little bit more of factors in the computation, but that's about it. Adam Company is considering manufacturing specialized part. So Adam wanted to buy initial equipment costing $160. Adam would need working capital for $115. So after Adam buys this equipment, they will need some working capital, supplies, inventory for this equipment. Then for the next 5 years, Adam will make, so let's start to put this on a timeline. So here's what we're talking about here. Initially $160,000 for the cost of the equipment minus $115,000 for the working capital. Then 1, 2, 3, 4, 5. In the next 5 year, every year there's an 80,000. Those are the positives. 80,000 and 80,000 of income, of cash flow, not income, cash flow. The discount rate is 11%. Year three, we have to do an equipment upgrade and we have to pay 40,000. So notice this is negative 40,000. This is positive, 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 the 80,000, the negative 40,000. And at the end of the 5th year, guess what? We're going to get $10,000 for this equipment. For the $160,000 equipment, we can sell it for $10,000. Now, what do? We are going to discount all this information. These two don't need any discounting because this is today. So we need to discount the 80,000 as an annuity. We need to discount the 40,000 separately. We need to discount the 10,000 separately. And what we do is first we compute our initial investment, 275. Then we discount the 40,000 at 11%. And we discount, which is what? How do we do this? We go to the present value of 1, the present value of a single amount. Let me show you the tables. This way it's easier for you rather than saying where these numbers are coming from. So let me show you how we come up with $29,240 for this 40,000 that you remember year 1, 2, 3. We have to come up with this 40,000 in year 3. So what we do, we go to the present value of a single amount table and the period equal to 3. This is the present value of $1, period equal to 3. And we go across, and I believe the discount rate for this problem is 11%. We go across and we look up the rate, which is 11%, which is 0.731. Now what we do is we take the amount, 40,000. Let me just double check on my calculator, make sure I computed this right. 40,000 times what did I say? 0.731. And this will give us 29,240. So the 29,240 now we brought it to the present. And in addition to that, we have 275. So those are all the negatives, 304,240. Now we have, remember, we have $80,000 year 3, year 4, and year 5. Each X equal to 80,000. Now what we do, since each X equal to 80,000, we have an annuity that we're discounting at 11% 5 period. Now we go to the present value of an annuity. We are using 11% 5 periods, and this is 11% 5 periods. It's 3.696. 3.696. And we multiply that by the cash flow of 80,000. And we find that the present value of all these payments equal to positive 295,680. And we're going to get the $10,000 for the salvage value. Again, what do we have to do? We have to find the present value of this 10,000 going to the present value of a single amount. So the present value of $1, 11%, 5 period, 0.593, and 10,000 times 0.593 equal to 5,930. Now we are ready to, okay, and we also were going to recover the working capital recovery at 11%. That's equal to 68,000. Also, we're going to recover this amount, but discounted. So we're not going to get the 115. It's have to be discounted at 11%, which is the same factor, 0.593. Then we'll take 115 times 0.593 will give us 68,000. Now we add all the cash inflows equal 369,705. We'll take the inflows minus the outflows and we have a positive. Therefore, the project is accepted. We have a positive cash flow of 65,465. We have a net positive NPV. The project is accepted. The project is accepted. Now, what are the challenging for using NPV? Well, it's a powerful tool. However, remember what we did. We estimated the cash flow. We estimated the future cash flow. We made assumptions about revenues and cost. Well, those could increase, those could change, those could go down. They could go down to zero. We don't know. Assumptions. Assumptions are risk. The second risk that we take is when we use a discount rate. Now we used 11%. If we use 10% or 13%, we'll have a different number. So be careful which discount rate the company uses. For example, launching a new product in untested market may require robust market research to support cash flow estimate. So if you have a new project, you're going to have a lot of guessing to go. So you're going to have to do a lot of what? Research. A lot of work. Takeaways. Remember, positive NPV, you accept the project because it creates value. Remember what creates value? Remember that home that we bought, then we fixed, then we sold. We created $100,000 in value. That was the positive NPV. Think of that home. But when you have a longer term project, you discount everything to the present value. That's why I started with this simple example. You would reject the project if it has negative NPV. Negative NPV means you are destroying value. So you remember that house, you bought it for $250. You put repair in it for $250. Let's assume you end up selling it for $450. Then you have a loss. You destroyed $50,000 in value. Zero NPV, it's you're earning exactly your discount rate. That's basically what it is. You have to consider other factors like strategic alignment or alternative matrix. You have to look at other factors if it's zero. NPV is just a number. Remember, it's a strategic framework to help you make a decision, but not the complete picture. The complete picture, you have to take everything into account. Now, this is good. How about if you have more than one NPV, more than one project? What do you have to do? Well, you have to determine whether the projects are independent or mutually exclusive. What is independent? What's mutually exclusive? Independent means the projects are unrelated and accepting one does not impact the other. So if you have 5 NPV projects and they're all independent, you have enough money to finance them, you go with all 5. So multiple projects can be accepted if they meet the criteria, which is positive NPV. If the projects are mutually exclusive means, look, if we undertake this project, we may not be able to undertake the others. And that's most of the time the case because companies don't have unlimited amount of money. When they undertake a project, they have to take into account how much money they have versus how many projects that have a positive NPV and select. Which project are we going to select? Well, we're going to have a criteria. Projects competes directly. Accepting one will exclude the others. Only one project is chosen. Typically, we're going to say this typically, but we're going to change this in a moment. You would say because of the highest positive NPV. Not necessarily the highest positive NPV. We're going to look at later at something called profitability index, and based on that it's a better figure. But if you're only looking at, you don't know anything about profitability index and you have 2 projects and one with a higher NPV, here what we're assuming is this. You're assuming you invest 100,000 and you make 150, or you invest 100,000 and you make 140. So those are the minus, those are the pluses. Obviously, as long as the minuses are the same, obviously we'll take the first project because it has a positive 50 and this one has positive 40. Then we'll take positive NPV. But the problem that oftentimes those 2 projects, we're assuming they're the same. It means they cost the same. What's going to happen once you change the cost, then we have to look at something else, which we'll talk about. Just wait until we talked about the profitability index. So a higher NPV is better when the initial cost or the negative is the same for both. Let's take a look at this multiple choice question from farhatlectures.com. Which of the following is a benefit of applying the NPV to capital budgeting? So what's a positive about NPV? The NPV method allows for different rates of return to be used for each year of the project's life. Yes. When you are computing the NPV, I used 11%, but when you are looking at a stream of cash flows, you can discount the first 80,000 at 11%, you can discount the second 80,000 at 10%, you can discount the third 80,000 at 14%. So you can have that. So the answer A is correct. So one could be right and C could be right. D and A are out. The NPV method helps identify whether an investments meet the minimum rate of return. Would it help us? Yes, NPV, if it's positive, it means it met the minimum rate of return. Both statements are right. Therefore, the answer is C. What should you know? What should you do? If you're a student or studying for a professional certification, CAPA, CMA, or any other certification, go to Farhat Lectures. I have additional resources that's going to help you. invest in yourself. That's the best investment. That's the greatest NPV you can get, is investing in yourself. Study hard and stay safe.